Hello again and welcome back to the channel. We're talking market moves, and sometimes the most intriguing ones happen right at the top. Imagine a director at a major automotive company selling off a significant chunk of their shares. Is it a distress signal or just business as usual? Today, we're diving into a recent insider transaction at the global automotive giant Lear Corporation and exploring why, despite a director cashing out, many on Wall Street remain exceptionally bullish. Stick with me because there's more to this story than you might think. On June 16, 2025, Conrad L. Mallett Jr., a director at Lear Corporation, stock ticker LEA, executed a notable sale. He divested precisely 1,187 shares of the company's stock. This transaction occurred when Lear shares were trading at $92.86, bringing the total value of this sale to slightly over $110,200, specifically $110,224.82. Following this significant divestment, Mr. Mallett's ownership in the company sharply decreased to just 84 shares, valued at approximately $7,800.24. This represents a striking 93.39% decrease in his direct stock ownership. It's also worth noting that over the past year, this has been Mr. Mallett's only stock sale, with no purchases made during the same period. While Lear Corporation's overall insider transaction history over the last year shows an even split between one insider buy and one insider sell, this particular move by a director certainly grabs attention and naturally raises questions about its implications. So, who is Lear Corporation? If you've been in a car recently, you've likely experienced their work. Lear is a global leader in automotive technology, particularly renowned for its seating and E-System segments. They play a crucial role in enabling superior in-vehicle experiences for consumers worldwide. Their extensive capabilities span every aspect of the automotive value chain, from advanced engineering and design to the final manufacturing and assembly of complex components. Think of everything from the customized comfort of your car seat to the intricate electrical architecture and electronic systems that power your vehicle's features. Lear is critical in bringing these to life. Even within its seating segment alone, their product portfolio is incredibly broad, encompassing full seat systems, critical subsystems like seat structures and mechanisms, key components, seat trim covers, innovative seat foams, and even the selection and processing of surface materials like premium leather and various fabrics for a wide range of automobiles, light trucks, compact cars, pickup trucks, and sport utility vehicles. Furthermore, their global operational footprint spans North America, Europe, Africa, Asia, and South America, underscoring their wide reach and influence in the global automotive industry. Now, let's turn to the numbers. Despite Mr. Mallett's sale, Lear Corporation presents a compelling financial picture that has largely reassured the market. For the first quarter of 2025, the company reported robust earnings per share, EPS, of $3.12, impressively surpassing analysts' consensus estimates of $2.64 by a healthy margin of 48 cents. Quarterly revenues also exceeded expectations, coming in at $5.56 billion against an anticipated $5.47 billion. While this revenue figure represents a 7.2% year-over-year decrease compared to the $3.18 EPS achieved in the same quarter last year, the company exhibited strong profitability metrics with a healthy 14.53% return on equity and a 2.09% net profit margin. Beyond profitability, Lear also demonstrated solid liquidity and manageable debt, evidenced by a quick ratio of 1.03, a current ratio of 1.32, and a debt-to-equity ratio of 0.57. These figures underscore the company's operational efficiency and sound financial health. Looking ahead, analysts are quite optimistic, with the consensus expectation for Lear to post 12.89 EPS for the current fiscal year, indicating continued confidence in strong performance. When considering valuation, the picture becomes even more interesting, presenting a significant opportunity. On the day of the director's recent sale, Lear stock traded at $92.86, valuing the company's market capitalization at approximately $4.87 billion. The company's price-earnings earnings ratio stood at 10.68. This is notably lower than the industry median of 17.48 and also below Lear's own historical PE ratio, signaling an attractive entry point. Furthermore, the company's price-to-earnings growth ratio, PEG ratio, is low of 0.51, suggesting strong earnings growth relative to its PE multiple. An independent analysis of intrinsic value suggests that Lear Corporation is significantly undervalued. Based on a comprehensive valuation model that considers historical multiples such as price-earnings ratio, price-sales ratio, and price-book ratio, a Guru focus adjustment factor for the company's past returns and growth, and future estimates of business performance from Morningstar analysts, Lear's intrinsic value is estimated to be approximately $145.02. This robust analysis leads to a price-to-GF value ratio of 0.64, strongly indicating that the stock is currently trading at a substantial discount to its estimated fair value. What's the general sentiment from Wall Street? The consensus rating for Lear Corporation is currently hold, with the consensus target price of $107.09. However, a closer look reveals a nuanced mix of opinions, leaning towards a positive outlook. While one analyst has issued a sell rating, 8 analysts have advised to hold, and 5 analysts have given a buy rating. Several notable adjustments have been made by leading firms. JP Morgan Chase & Co. recently raised its price target for Lear from $119 to $120, maintaining an overweight rating, citing the company's strong first quarter results. Morgan Stanley also holds an overweight rating, though it slightly adjusted its price target from $125 to $115. Meanwhile, Goldman Sachs maintains a neutral rating with an $88 price target, and Cowen recently downgraded its rating from buy to hold. Beyond these traditional analyst views, AI-powered analyses like Spark AI on TipRanks have also flagged LEA as an outperform stock. This assessment stems from Lear's strong financial performance, healthy valuation, attractive dividend yield, and strategic operational improvements, while also acknowledging some mixed signals from technical analysis and external trade uncertainties. This indicates a nuanced but generally positive sentiment among analysts, highlighting the company's resilience and future growth potential. Beyond potential capital gains, Lear also offers a noteworthy dividend for income-focused investors. The company recently announced a quarterly dividend of $0.77, which translates to an annualized dividend of $3.08. At its current price, this provides a competitive dividend yield of 3.40%. With a payout ratio of 36.11%, the dividend appears quite sustainable, showcasing the company's ability to consistently return value to shareholders while retaining sufficient capital for future growth and operational needs. The ex-dividend date was set for Thursday, June 5th, with the dividend payable on Wednesday, June 25th. It's also important to consider the activity of institutional investors, as they typically hold the lion's share of publicly traded companies, and their movements can signal significant confidence. In Lear's case, hedge funds and other institutional investors own a staggering 97.04% of the company's stock, indicating a high level of institutional conviction. Furthermore, many of these major players have actively increased their positions in recent quarters. For example, Addison Advisors LLC boosted its holdings in Lear by 68.2% during the fourth quarter. WPG Advisors LLC acquired a new position in the first quarter, while Quadrant Capital Group LLC increased its position by a notable 51.1% in the fourth quarter. Putney Financial Group also bought a new stake in the fourth quarter. So, what's the bottom line? While a major insider sale like this naturally raises questions, the broader context suggests Lear Corporation remains on solid footing. With strong earnings, a healthy dividend, and widespread institutional support, the fundamentals tell a different story, one of resilience and long-term potential. Whether you're a value investor eyeing the discount or a yield seeker drawn to the dividend, Lear might deserve a closer look. Thanks for watching. Don't forget to like, subscribe, and hit the bell so you never miss a market insight. See you in the next one.